Before we dive into the conversation, I'd like to take a moment to just introduce our guest today, Bob Elliott. Bob is the co-founder, CEO, and CIO of Unlimited Funds, which uses machine learning to create low-cost index replications of 2 and 20 style alternative investments like hedge funds, venture capital, and private equity. Prior to founding Unlimited, he served on the investment committee at Bridgewater Associates, where he helped build and lead Ray Dalio's investment research team for nearly a decade. At the firm, Bob developed investment strategies across equities, fixed income, credit, exchange rates, and commodities, including many used in the flagship Pure Alpha Fund. In his time there, he also authored many of Bridgewater's widely read daily observations. Bob graduated from Harvard and holds a Bachelor of Arts in History and Science. So with that, Bob, thanks so much for joining us today.
Yeah, thanks so much for having me. Excited to be here.
Great. So we'll start off with a few questions that we have prepared, and then we'll open it up for Q&A from the audience for the last 15 or 20 minutes, if that's all right with you.
Yeah, that works great.
Perfect. To kind of kick things off, I'm curious to hear about how your background in history and science specifically kind of led you to the world of investing and to Bridgewater initially.
Yeah, I mean, in many ways, I come from a pretty non-traditional background when it comes to asset management, having basically my entire academic experience in the pure sciences. And I think in a lot of ways, that background has been particularly valuable for me. In a lot of ways, the pure sciences connects very well with how I think about markets and the macroeconomy and the interplay between them. You know, in the same way you can think about plant biology as being the intersection of a number of different systems, all creating a larger macroeconomic or macro outcome related to whether the plant grows or not. So too, can you think about the macroeconomy and markets as an intersection of a bunch of different related and intersecting dynamics that are playing out at any time. And so I found that perspective very valuable. And when you think about, when you think about building an understanding of markets and trading markets, in order to generate alpha, you have to have a unique and differentiated perspective. And so you have to get away. The Wharton educators probably don't want you to hear this, but everyone knows everything you're learning in a day-to-day basis in the classroom. That's well known. In order to generate unique insight, you have to go beyond what's in the classroom. It's not to say what's in the classroom is a problem or or is wrong. It just means in order to generate alpha, you have to have a differentiated insight beyond what's in the classroom. And so having different perspectives, whether it's through your own experience or bringing different people with different experiences around the table to generate that perspective, I think is very valuable. And so, that from an investment philosophy perspective has always been a critical part of, I think, what's given me edge to build unique understanding. And then in terms of how I transitioned from that to Bridgewater and really getting in from the plant sciences, as botany was really my major. It really came down to I spent a fair amount of time on health-related policy as an extracurricular while I was at Harvard, particularly around the HIV and AIDS epidemic back in the early 2000s, and quickly understood that macroeconomic dynamics were a primary driver of what was going on with health outcomes in the global South. And interestingly enough, sort of said to myself, when I learned about Bridgewater, I said, look, I'm going to go, maybe I'll do it for a year or two. They'll pay me nicely. I'll basically get, a master's in macroeconomics and go do something else. And really fell in love with markets and trading and macroeconomics. And, man, that's 20 years later. I'm still doing it.
Yeah, that's great. So I'd love to hear a little more about, those early days at Bridgewater. What, in your view, were the kind of core principles or practices on the investment side and on the culture side that you think allowed the firm to be so successful in your time there?
Well, I think probably the biggest thing in terms of investment philosophy is this this core idea there of systemization of understanding. I think, there's a lot of folks who, when in the investing universe, who primarily trade from a discretionary perspective. And I find that to be very hard, very, very challenging. And I think in particular, because it's hard to every day rework your entire investment framework from the ground up and not be influenced by all of the things that can influence, your behavior in a given day. And so systemization is really critically important. When I say systemization, sometimes people think, huge, massive, complex black boxes that are spitting out, things that are not understood. All I mean when I say systemization is, if you have an understanding about how the world works in a particular way, write that thing down, test it back through time in a rigorous way, hold yourself accountable to not, data mine. And if it's a good capturing of the concept of what drives what's going on in markets and economies, then just use that understanding, write that understanding down, and have computers do what they're good at, which is take in data, run algorithms, spit out answers to previously constructed algorithms, and free yourself from having to reconstruct that on a daily basis, and basically compound beyond that base level of understanding. And so I think that approach to trading, it created an acceleration of understanding, because essentially all of the known understanding that had already existed and been developed over decades was already being used to trade markets. And so what we could do, what I could do, as a person who is responsible for meaningful portions of the pure alpha portfolio, is I could observe what our current understanding is, observe what was happening in markets, and basically constantly question what is the next thing that I don't understand, and the next thing, and the next thing. And that is, for what it's worth, in markets, the beautiful thing. Like, why do people who trade markets, I mean, who are, billionaires many times over, why do they keep trading markets? It's because it is chasing something that you will never fully understand, right? Because there's always so much more to understand with the macroeconomy and markets, that you are never satisfied in terms of understanding. You can be a surgeon and look, how to do that brain surgery better than anybody, and you'll just do it over and over and over again. And markets are totally different. I can, and probably, most likely will spend the rest of my life working on markets, and there will still be things at the end of it that I still haven't mastered or understood. And so that's, I think that's a really critical thing. And then I think from a cultural perspective, Bridgewater, there's a lot of stuff out there about the culture, and it's not really worth going into all the gossipy stories and stuff like that related to the culture. The reality is those core group of people who are running the money, which is, there are only like 10 or 15 core people who are primarily directing, responsible for leading the investment process. That group functioned like any other high performing group, which is, when you're in a high performing group, you don't pull the punches, you don't play politics. Markets are very hard. You have to be, direct, honest, rigorous, in terms of developing and stress testing the way in which you're running money. Any fiduciary should be that way. And so, what I'd say is, you can open the book on any high performing organization, and it basically looked like what was being done to run the money, and all the sort of extraneous stuff, frankly, was not happening particularly close to the people who are actually running the money.
Got it. So we kind of take that, chase for, understanding markets today, over the last 4 months, we've gone from the market pricing in up to 7 rate cuts for 2024 to a point where, now there's some discussion about possible hiking. So if we just take a step back, where do you think the economy is at today in this current cycle, relative to how these cycles have traditionally played out in the past?
Yeah, I think in a lot of ways what we're experiencing is a very normal cycle, which is unusual for most people in their professional lives. Most of the cycles that we've experienced in our professional careers have been boom bust type cycles, whether it was, the 2000s tech bubble and bust, or whether it was the housing bubble and bust, or whether it was, COVID, which wasn't really a bubble, but it was a exogenous shock bust. And in all those circumstances, basically what happened was economic expansion was arrested by an unsustainable dynamic, whether it was an unsustainable bubble in asset prices, unsustainable debt growth in 2008, or, a health crisis that made working unsustainable. And so in all those circumstances, I think there was this sense, particularly in 2000 and 2008, this sense of inevitability of a downturn occurring, because there's no way that the excesses that were being built up during those periods could persist. In 2000, actually, there's a lot, there's the asset price bubble, but there was also a huge debt boom related to infrastructure investment, company infrastructure investment related to the technology universe as well. A lot of debt-driven fixed investment. And the thing that's happening today is totally different. What we're having today is much more of an old-time economic expansion, where income growth is the primary financer of economic activity, meaning people's wages are growing at a reasonable pace, 5 or 6% a year. They're spending at 5 or 6% a year. That's then translating to somebody else's income, which is 5 or 6% a year. And they're spending 5 or 6% a year. And so we're getting this sort of virtuous cycle of spending in the economy that is actually quite sustainable. In the same way, economic expansions back in the 50s and 60s were typically quite sustainable because they were not debt-driven. In a debt-driven economic expansion, eventually you got to pay back the debt, so there's only so much debt you can take. In an income-driven expansion, that can continue for an extended period of time. And so what we're having instead is basically an old-time cycle from the 50s or 60s, where the strength in those conditions is then creating an economic expansion. The economy is too hot relative to the underlying, productivity in the economy, which means that we're having inflationary pressures. And the central bank, the Fed, is just responding to those inflationary pressures in the way a central bank typically would in a late cycle environment, by tightening monetary policy. And the trouble is, we haven't necessarily tightened monetary policy enough to break the inflationary pressures that are in the economy. And that's basically what we're seeing right now. Is we moved from a point, 3 or 4 months ago, where at least the market perception was that we had done enough, and the Fed's own commentary that we had done enough to break the cycle of inflation. And now recognizing again that maybe that's not really right, and that more tightening needs to be done in order to bring inflation sustainably back down to the 2% target. And so that's kind of where we are right now, which is very late cycle. And at this point where inflation is still too high, and we need more tightening for the Fed to achieve its aims.
And so if we kind of take that and look forward, what do you think still needs to occur then for inflation to return sustainably to that 2% target? What kind of, components of the economy do you have your eye on?
Right. Well, the easy stuff is basically the easy way to bring down inflation has already been done. That's kind of the challenge. We've resolved a lot of supply chain issues. That's brought inflation down. And we've also benefited from a significant amount of labor supply, both from an increase in domestic labor participation and also from a significant influx of immigration. And the problem is, we've sort of reached the limits of both of those levers now that labor force participation is at multi-decade highs. And whether or not you agree with the politics of it, certainly moves are being made to limit the amount of immigration that's occurring in the economy. And so you put that together with that set of changes, we've only been able to bring inflation down to 3 or 4%, not to 2%. The Fed's target is 2%, and responsibly below 2%. And so what that means is, in order to further bring inflation down, we've got to start to create, we either have to give up on the inflation target, or create demand side slowing through either tighter monetary policy from the Fed or from essentially a market-based tightening. And given the Fed has basically said we're going to keep rates where they are and have not really signaled hiking. I mean, they sort of said basically like it's possible we could hike because anything's possible. Really what it comes down to is whether the markets, the financial markets, are going to do enough to create a sufficient tightening of the economy from a market-based standpoint to create a sufficient slowing to then start to slow the economy and ease inflationary pressures. And that's really where we stand now with, stocks really pricing in a strong economy, short rates now reflecting, the fact that the economy is relatively strong and inflation pressures remain persistent. But really what hasn't priced it in is the term premium or the long bond, which is still relatively low in comparison to both the short end as well as the typical term premium that exists in interest rates given the strength of the economy. And so that's really what we're probably most likely to see, which is an interest rate rise. We've seen some of that in recent period, but we really need that interest rate rise in order to slow the economy, in order to break the inflationary pressures. Or what's going to happen is the Fed is going to have to do more work.
Right. And so as someone that, is watching the Fed and watching markets kind of together, how do you deal with the kind of uncertainty around the timing of those changes and making bets on that timing? Just last week, Chair Powell said, it's appropriate for the Fed to allow restrictive policy further time to work. So how should we as investors think about forecasting that timing, if at all?
Yeah, I mean, I think I probably shouldn't say this to a group that brought Neil Kashkari in for a conversation, but you shouldn't listen to anything that Jerome Powell or any of the governors have to say at all. It will provide you absolutely no value, no alpha value in predicting what's likely to transpire. The Fed, and this last 3 months, is 3 or 4 months, is such a good indication of that, which is the Fed responds to the data. The Fed doesn't respond to their predictions. The Fed doesn't respond to their guesses. The Fed responds to the data. And so if you want to get a lead on the Fed, stop listening to what they have to say because they have no idea. They have no predictive ability. The Fed has no predictive ability. And so if you want to understand what they're going to do, understand what is going on with the data that they use to respond to, and even better, predict the data that they're going to use to respond. And so when you're thinking about, how do you interpret what's going on, I think it's important to connect what is most likely to happen with the data that they're responsive to. And so as an example, if we went back in, January, I sent out an outlook in the beginning of January, and I basically said, it looks like the macroeconomy is likely to be stronger for longer than what's expected. And that's because of combination of different things, in part because stocks had gone up a fair amount, which was a positive stimulative effect of the economy, and interest rates had come down, which essentially was a big financial market easing, which would create a reacceleration or continued strength in the economy and a continued elevation of inflation pressures. And so that gives you a good example. So whatever, the Fed said 3, the market said 6 to 7. And when you looked at what was likely to drive the macroeconomic outcomes in the next 3 or 6 months, it basically looked like 0 was the right answer. And so that's alpha. That's where the alpha opportunity is understanding how the data is likely to transpire, not listening to what they have to say. Now, today, conditions are quite a bit different in the sense of, essentially the market pricing. You always have to start with the market pricing. Whenever you're betting on markets, start with the market pricing, start with what's priced in, and predict what's likely to transpire relative to what's priced in. On the short rate market, look, what's priced in is basically, one-ish cuts over the course of 2024. Are they, could it be 0? Could it be 2? Who knows? It's not 6 or 7. The easy money's been made. I think the mispricing in the short rate market is not that interesting at this point. On the margin, I think it's probably going to be tighter than what's priced, but it's a pretty low alpha trade at this point. Whereas when you look at the overall environment, what you see is basically stocks are priced in a way that they're reflecting an expectation of continued very strong growth in an environment where we've had a meaningful interest rate rise over the course of the last 3 or 6 months. And this is one of the interesting things that, which would typically indicate that we're likely to see a slowing, but expectations are for growth to be as strong as it's been, in the last couple of years, despite the fact we've basically had a market-based tightening over the course of the last 3 or 4 months. And so those are the sorts of dynamics, right? You want to think about, okay, well, what are the Fed is going to decide based upon certain data. What drives that data? What is priced in related to that data? And where's their gap between those two things? So there's not much of a gap in the short rate market, but there's actually a fair amount of gap in the equity market right now. And we're seeing basically that dynamic play out where, equities can't, bond yields are high enough right now where it seems like every day we come in and equities try their darndest to get a bid and they just can't quite get a bid. And that's because expectations of earnings growth are very high and because we're experiencing a monetary tightening ahead. And so that's really the more interesting area of the market is the long end of the bond market and the equity market, much more so than what's going on with short rates.
Got it. And kind of zooming in a little more closely on, something that the Fed believes versus what the market believes. Curious to hear your thoughts on this kind of growing debate regarding the long-term kind of neutral interest rate. And first, obviously very difficult to get to a precise value, but what do you see as the kind of primary factors that are driving possible shifts in R-star or the equilibrium rate?
Yeah, I mean, this connects to what's going on in the bond market, which is, like nominal growth is at 6%, unemployment rates at secular lows, inflation's too high, and the bond yield is still, 70 basis points below what's going on with the short rate, 70 or 80 basis points below what's going on in the short rate, and the term premium in bonds is 0. And you look at that and you say, how the heck could that be? And then what you do is you flip on Bloomberg in the morning and you listen to what every long only bond manager says. And you know what every single one to a T says, 4.5% bonds, great deal, because long-term interest rates are going to be 2.5, just as they've been for the last 15 years. And that is creating a bid from those long only bond managers, which is keeping a lid on yields. Now that can't persist for forever, but I think it highlights one of the sort of key fundamental theories, I'd say, that's underpinning what's going on in the market today, which is that we are in the same cycle, the same macroeconomic environment, longer term macroeconomic environment today as we were prior to COVID. And I think and the same is true with the Fed. Look, the Fed's dots are at 2.5% too, right? So it's not like it's just these crazy long only bond managers. I mean, it's the Fed also thinks the same thing, or at least the governors will state that in terms of their dots. And I think there's lots of good reason to believe that has meaningfully shifted over the course of the last 5 or 10 years. I mean, look, most of you didn't directly experience the financial crisis and the period that existed after that. It's hard to impress on people how terrible that environment was,
right?
How depressed the economy was, how challenging it was to create a stimulation in the economy and to get people back to engaging in economic conditions. And the reason why that was is we were at the edge. We looked over the edge and saw the abyss of the global financial system collapsing. And that created scars in the same way that it created scars for people who lived through the Great Depression. And so that created an environment of risk aversion, and in particular, an environment where people wanted to save a lot relative to borrow a lot to invest and expand following the financial crisis. And so in an environment of excess savings and low demand to borrow, the neutral interest rate is quite low. That has changed a fair amount because we've had 15 years to heal balance sheets. Household balance sheets are basically as good as they've been in many decades. Corporate balance sheets are as good as they've been in many decades. And so we have a circumstance where the desire to lever back up, the desire to borrow is starting to pick up, and where 15 years of essentially stocks only going up and house prices only going up has reduced the desire to save. In addition, from a global perspective, surpluses that existed that kept long-term interest rates much more depressed, like the recycling of Asian reserve balances, those have also dried up as well. And so you have that excess savings that exists in the East also fading. And so you have this circumstance where the supply and demand for capital from a longer term perspective is likely to be favoring more, favoring higher interest rates rather than lower interest rates, particularly relative to where we were in the post GFC period, right? Much more desire to borrow incrementally and much less desire to save incrementally than where we were when the longer term neutral interest rate was about 2.5%. That is combined with the fact that in many ways, some of those sort of more secular disinflationary drivers are also drying up as well. For 20, 30 years, the industrialization of China and moving hundreds of millions of people from farm to factory was a huge disinflationary impulse in the global economy, particularly with manufactured goods prices. The move to globalization that occurred over that same time frame, also a huge disinflationary pressure. And frankly, the peace dividend that existed for a long time was a big disinflationary pressure. And all three of those things are basically drying up. At this point, urbanization in China is basically stopped. We are having fracturing rather than integration, right? We went from high pace of integration to now an increasing pace of fracturing and creation of parallel supply chains, all of which are more inflationary and demand capital to create them. Those chip factories in Arizona aren't going to build themselves. Like, you got to borrow the money in order to build them, in order to onshore and friendshore. And frankly, the commodity supply demand that kept commodity prices very low for an extended period of time, because we didn't have a lot of international conflict. In fact, we were at 1,000-year low in terms of international conflict in the last couple of decades in the 90s and the aughts. That's also reversing, which creates pressure on commodity prices, because all war is basically digging stuff out of the ground and destroying it, and digging stuff out of the ground and destroying it from a macroeconomic perspective, from a commodity supply demand perspective. And so, which is very different from, typical environments with less conflict, where productive capacity is created through the use of commodities. And so we're entering a period where inflation pressures are likely more elevated, and where that balance between savings and demand for capital is now increasing on the demand for capital side. All of that points to the fact that 2.5% long-term interest rates don't make any sense anymore. And so if you go back to those long-only bond managers or the Fed, at some point they will stop penciling in 2.5% for their long-term bond expectation. And if the long-term bond expectation is something that looks like 4 instead of 2.5%, well, that would radically change what's going on with the pricing of the long end. And I think, we're incrementally seeing that play out today.
Right. And so how, if we kind of take that higher neutral rate assumption, how does kind of optimal portfolio construction change? And how do those systems, that Bridgewater and maybe others have developed change? What kind of assumptions have to be undone if the neutral rate is in fact higher, like you mentioned?
Well, there's got to be repricing of financial assets. And I think folks often forget that there are bonds in all assets. And what I mean by that is every financial asset is, the price today of every financial asset is the discounted cash flows of the future value, right? The discounting of the future value. And the discount rate, and in particular, the term premium, right? The amount of return that you need to receive in order to forego your capital today and get it into the future is something that's a price in all assets. And so what we've seen is basically a period of 15 years where the discount rates of assets were very, very low, which meant that the prices of all assets were supported. Now, as we change that pricing, right, as we go from a period, let's say, if you look at typical term premium models where in the post-GFC period, they've been running at 0 or slightly negative, and we were to return to the type of term premium that existed in in the pre-GFC period or even in the 90s period, which would be more aligned with the conditions that we're experiencing today, you could easily have 100 or 200 basis points of discount rates affect assets. Now, each asset has different duration, but say you look at stocks and let's say stocks have a 15-year duration, just as a simple example. Well, if interest rates go up 200 basis points solely from the discounting factor, you'd expect stocks to go down something like 30%. And so, that gives you a sense as to the sensitivity. That interest rate affects all assets. And so in a lot of ways, what we're seeing, people sort of talk about it as, well, stocks and bonds are positively correlated and things like that. But what's actually happening is the recognition of bonds are in the assets. There are bonds in the stocks, bonds in commodities, bonds in gold, right? In corporate bonds and corporate bonds, right? They're in all these assets. And as that term premium changes, it's driving the overall value of the assets. And so what would happen if we tomorrow, let's just say everyone woke up and said, the neutral rate is 150 basis points higher than what we thought it was. Well, then all assets would have to reflect a higher discount rate, which would mean that all assets would be hit in terms of their price.
Right. And so now kind of pivoting over to the more fiscal side of things, how do you think about, the risk of the persistently high government deficits that we've seen recently, especially considering that neither of the two presidential candidates on the ballot are likely to, curtail spending upon taking office?
Yeah, I think you could think about that in sort of two different elements of it, which is one, if you think about it from a macroeconomic perspective or a growth perspective, persistent elevated deficits are not necessarily that beneficial to growth. Now, this is probably a perspective that you're not going to hear that's incongruous with the consensus, where people talk about the direct deficit being the primary driver of U.S. growth. I don't believe that that's true, and have written extensively about why that is. But to help build the sort of core intuition, if you think about deficits simply as let's just say you oversimplify what the government does. You just say what the government does is it takes in taxes and it engages in transfer payments. Well, if transfer payments in period one are $100 and transfer payment, say they take in no taxes and they borrow and do a transfer payment of $100. If in period one, they do a $100 transfer payment, what that does is it supports someone's income by $100 and their spending by $100. And the government's deficit is $100. If in period two, the government does the same exact thing, $100 of transfer payments, $0 of taxes, transfers it over, someone's income in period two is $100 supplemented, their spending is $100 supplemented. The GDP growth impact of that is zero. GDP growth impact is zero if deficits are constant. And so instead, in order to get economic expansion, growth from deficits actually have to rise in size in order to increase growth. And that's not what we're seeing right now. We're seeing large deficits, but actually the deficit today is down from where it was a few years ago, immediately after COVID. And so what that highlights is, from an economic perspective, deficits are not driving the expansion of economic conditions. Deficits are supporting the level of spending, but they are not driving the growth rate in spending. As a simple example, in the last 3 years, US GDP on an annualized basis is up $7 trillion, and deficits have contracted by about $1 trillion annualized rate. What's filling that gap is income. Income is driving growth. That's what's going on with the deficits from a macroeconomics standpoint. It's not the deficits driving growth in the last couple of years, it's income driving growth. From a bond supply demand perspective, from a markets perspective, the level of deficits is actually quite relevant to what's going on with the bond price. When you think about what's going on with the bond price, any market is just supply and demand going on. In the US government bond market, there's one supplier. It is the government issuing the bonds, right? That's essentially sales, bond sales. And then the question is, who's demanding the bonds? The persistent large level of deficit means that we have a big supply of duration coming into the market, which has to be bought every day. Every day there's a bond auction, and those bond auctions are larger than they've basically ever been, except during the very height of COVID. And so I think that's very interesting because essentially what it's doing, it's creating a persistent downward pressure on bond prices, upward pressure on yields, because they have to find an incremental buyer, an incremental buyer, an incremental buyer to buy all of that duration supply. And, right here in the second quarter, we have about twice as much net duration supply as existed in previous quarters because those deficits are so large. And so what it's creating is the level of the deficit is creating a weight on bond prices or an upward pressure on yields. And then that upward pressure on yields is then flowing through to what the discount rate is on all assets. And that discount rate on all assets is flowing through to asset prices. And those asset prices are what ultimately influence whether or not people, continue to spend and save at the same pace that they have been, or start to pull back and start to create that economic slowing.
Got it. And so before I open it up to the audience, I think it'd be great to hear a little bit more about the work that you're currently doing at Unlimited. So I think just to start, can you talk about what the kind of core thesis was that motivated the founding of the firm?
Yeah, I mean, it's probably not good to tell all these folks who are on here in the job hunt, probably trying to work for 2 and 20 businesses eventually, like hedge funds and venture capital and private equity, that those businesses are getting disrupted. And I'll tell you why. Like, look, 2 and 20 businesses earn about $700 billion a year in fees. And it's one of the very few areas of the economy that basically look unchanged over the course of the last 40 years and where the pricing is unchanged. Like everything else we do is different, but hedge fund managers still charge 2 and 20. Venture investors still stare into the eyes of founders and, attempt to glean how those folks are doing and get paid handsomely for it. And the reality is, for investors, 2 and 20 businesses aren't very good. And the reason why that is the fees are too high. When, those managers generate a lot of alpha, and the problem is that they charge very high fees and investors aren't better off as a function of that. And so increasingly, investors are starting to recognize that those businesses are no longer make sense incrementally to invest in. And instead, sort of in parallel to this, what's happened is there's been an incredible set of innovation around the tools that we can use to replicate how those 2 and 20 managers are positioned at any point in time. And I won't go into all of that here, other than to say that low cost replication of those strategies is becoming increasingly compelling, both in terms of its quality as well as its price, at a time when people are becoming increasingly restless about the quality of returns and the fees that they're paying to those businesses. And so at Unlimited, what we're trying to do is basically bring the concepts of diversified low-cost indexing, which has obviously totally changed stock and bond investing, and bring that into the world in 2 and 20, leveraging the combination of our decades of experience having built proprietary 2 and 20 strategies, as well as modern machine learning approaches, and basically create an environment where we offer a compelling alternative, particularly on a fee-adjusted basis, to direct investing in these funds. And I think, whereas today replication for 2 and 20 strategies is like less than 1% of the overall 2 and 20 asset pool, very similar to what, stock indexing was in 1970. We're probably seeing a world where in the next 20 or 30 years, these sort of replication approaches they're going to consume 50 or 75% of the market, just as passive stock and bond investing is created, is taking up 50 or 75% of those markets over time.
Right. Great. So I think we have just over 15 minutes left. So I'll open it up for questions from the audience. If you guys do have a question, please go ahead and submit it through the Q&A feature, and we'll try to get through as many as we can here. All right. So first question comes from Jacob. Says Howard Marks has often described a sea change occurring in markets and has mentioned that we may be in a new regime. Do you kind of hold this view? And in your career, how often have you seen these kind of regimes last?
Yeah, I mean, I think the big picture theme that we've had from a sort of a secular theme that we've experienced over the last 40 years has been basically this concept of disinflationary growth driven by integration and peace. And that has been great for stocks and bonds, because that's basically, stocks and bonds are basically highly concentrated bets along that dimension, along basically all those dimensions, right? They're bets on low and stable inflation, they're bets on strong growth, they're bets on stability, and so that regime, I think, decayed, was very strong, I'd say, in the 80s and 90s and early 2000s, and started to decay in a way that accelerated following the global financial crisis. And really the COVID shock and the sort of subsequent consequences of the COVID shock really accelerated the shift away from those longer term trends that have driven, asset prices and the global economy. And I think it's one of the things that is, I think these regime shifts, like if you just think about, you think about how people think about the world, it's very tied to their experience. And when it's very tied to their experience, for instance, many people in the professional market have experienced, a couple of business cycles, and so they're familiar with them. But it's these sort of more nascent, more sort of underlying dynamics that they may not have experienced as explicitly as something like a business cycle that can change meaningfully and catch them totally off guard. I give one very small example. For years and years, everyone said the bond market was the smart money. And the reason why the bond market was the smart money is the bond market constantly predicted interest rate cuts. And why did it predict interest rate cuts? And was right about it. And it's because we were in this period of secular disinflation, which allowed the Fed to basically cut rates at each point in which they saw a weakness in growth. Well, in the last 3 or 4 years, the bond market has been the dumb money, right? I mean, how many times has the bond market been dead wrong about Fed policy? The last time it happened was 3 months ago, right? 6 to 7 cuts. What a joke, right? Totally wrong in the bond market. But what it reflects is the fact that that bond market and everyone's perception of the bond market, everyone's perception of who was smart and who was not smart, was a function of that secular dynamic, which is reversing. And so I think those are the more those multi-decade dynamics reversing are some of the more the greater opportunities, I'd say, for investors to take advantage of being positioned in a differentiated way.
Great. Question here, and one that comes up pretty frequently, I think, in Wharton webinars. So what are your thoughts on Bitcoin? Is it just a risk asset, or do you think there's a role for it in the modern portfolio?
Well, I led Bridgewater's research on Bitcoin about more than 10 years ago. Um, uh, and because of my role leading the exchange rate business and whether Bitcoin is a currency or not. And what I'd say about it is that at the time when I looked at it, I said this is not being driven by macroeconomic dynamics. It's not it's not fundamentally driven by the sort of properties that exchange rates are driven by. It's driven by idiosyncratic dynamics, and I think that's played out relatively clearly over the course of the last 10 years, and even more recently, where it looks more like Bitcoin pricing was driven by the regulatory changes and accessibility through the ETF infrastructure than it was driven by any sort of macroeconomic dynamics. And those macroeconomic dynamics, there's been a lot of stories like Bitcoin's an inflation hedge. It's clearly not. Bitcoin's a geopolitical hedge. It's clearly not. Those are empirical questions for which it's failed to pass the test in terms of being a macroeconomic portfolio asset. And so I think the main question, given that, is that given the uncertainty of it, makes sense to include in a portfolio when you have no understanding of what the primary drivers of its return profile look like. I think many institutional investors look at it and say that is a challenging asset to understand and include, given that the idiosyncratic nature of it is such that we can't does it diversify against stocks and bonds? Very hard for someone to assess. And so until those dynamics become clearer, it's unlikely to see widespread institutional adoption. And from an alpha perspective, you don't have to trade every market. In fact, there's lots of markets that you don't know anything about, or you don't have edge relative to people who are trading it, insiders, for instance, in the Bitcoin market. And so, don't trade things you don't have edge on. And I don't trade Bitcoin from an alpha perspective and never have.
Right. Question here from Kristen. With rising interest expense as a percentage of our annual spend, or excuse me, with interest expense as a percentage of our annual spend rising, Janet Yellen has continually attempted to talk down rates on the long end of the curve. How do you think about these issuance dynamics and the more market structure aspects of fixed income more generally?
Yeah, I think given that the biggest supplier of U.S. Treasury bonds is the federal government, their decisions in terms of their debt profile have meaningful influence on the price of the long end of the curve. Now, if you go back, the last couple of decades, that issuance profile has, for many years was primarily determined by technocrats who were following relatively distinct rules in terms of what that mix would be. Some real bond nerds at the Treasury. And I say that with great affection for what they do. But more recently and unusually, Janet Yellen has chosen to use the Treasury issuance debt profile, as a matter of policy rather than a matter of technocratic decision making, shifting the mix in which she's chosen to issue the debt based upon factors that are outside the typical considerations, and in particular upon seeing rising interest rates on the long end, choosing to issue less long duration bonds. Treasury is a political institution, very different from the Fed, very important to recognize those differences. And so, basically the question is she going to make decisions based upon political influence, or is she going to hold the technocratic tradition of the last couple of decades? And what I'd emphasize is nobody knows. A lot of opinions. The right view on this is you don't know. And part of the thing that's interesting about it from trading markets is the treasury behavior is such a huge influence on the market that you don't have to predict whether she's going to change the debt profile in one direction or another. They announce every 3 months at the QRA what the debt profile is. And if you simply respond to what they announce, you'll lead the market because their flows are so big, they can't, no one in the market can front run them. And so listen to what they have to say and respond rather than trying to predict, because like many matters in politics, it's very hard to predict what the decision making will be.
Right. Next question. Do you think the Fed will attempt to keep rates lower than otherwise, given the size of outstanding debt? And related to that, do you think that the next Fed chair, who will be appointed by the next president, will likely be selected to allow the inflation target of 2% to drift higher to, say, 2.5%?
Well, the Federal Reserve does not make any decisions based upon the amount of interest expense that the Treasury is facing. They may make decisions based upon the macroeconomic environment, growth, inflation, and financial stability, and that's it. And I can speak to having significant familiarity with that decision making process. And so this idea that the Fed is keeping interest rates lower than they otherwise would be because they're trying to limit interest expense is total nonsense. And so, could that interest expense influence the Fed's decision making? Possibly, but only through the perspective of if that higher interest expense created more fiscal constraint, which then created a slowing of economic conditions, which then created a shift in their policy. That could happen. But the path is through the macroeconomic data, not through consideration of what's happening at the Treasury or with the deficits.
Mm-hmm. So David Einhorn said recently that higher rates are actually stimulative. People have higher incomes and firms have lots of cash sitting on the balance sheets, which is resulting in an increase in interest income. So what do you think about this theory generally, and what it might mean for the outlook of the economy and for risk assets?
Yeah, well, I think it's a theory proposed by people who aren't doing the rigorous analytical work to assess the quantities of what is influenced by interest rates. Let's just take the basic, simple example of just the income side of the story. In order for higher interest rates to influence economic activity, that income growth, that income earned, has to translate into GDP impact. Most of the debt assets held in the US are held by non-GDP creating entities, pension funds, endowments, foreign central banks, right? Businesses for whom their primary reason for operating or the primary business decisions are related to, macroeconomic or cyclical circumstance, not related to the amount of income that they're earning on their bank deposits. And so the first most important point is that there's a lot of talk about all this income, but with very little care to understanding that connection, quantifying that connection to actual GDP effect. And even those like households who have a GDP effect, those who are earning that income, what do the rich people do when they earn the income on their T-bills? Does that meaningfully affect their spending? The answer is no. Right? Because their propensity to spend versus save is very different from those who would likely spend from higher wages. And so you put that all together, just on its face, the idea that it's a meaningful driver of spending doesn't hold up to the common sense test. Now, let me also say that you have to weigh higher interest rates against the negative effects that higher interest rates have on the economy related to increased borrowing, which clearly there's a very direct impact on increased borrowing. Just look at bank balance sheets and how much borrowing has slowed since interest rates have risen. And also the effect on asset prices, the incremental effect on asset prices, where higher interest rates, are a negative impact on asset prices on the margin. And you put that all together, and basically there's no way to make a quantitatively driven case that's based upon, fundamental factors where this idea holds any water. It's not even close, right? It's not close. And I think, often these things are sort of vaguely proposed by, disconnected, folks who are sort of, out there kind of professing general ideas rather than people who are literally doing the work to quantify whether or not it makes sense, right? So stay away from disconnected luminaries, like vaguely speculating, and focus on people who are adding up the numbers and doing the quantification necessary to make the assessments.
Right. So we'll finish off, I think, with two questions related.
I have nothing
to
against David. I don't even know David Einhorn from anybody. I'm just saying that's a very popular theory that's out there that just doesn't hold water if you do the work to really understand it.
That makes sense. Yeah, so we'll just finish off with one or two more questions here. One coming from an anonymous attendee. Do you think that Bridgewater's investing style will remain relevant, or will multi-strategy and quant funds start to gain more and more in popularity?
Well, I'm not going to comment on a specific investment style. I think the general idea that you generate better returns if you are able to bring together the more different strategies that you're bringing to the table that have positive alpha, just by nature of diversification, should lead to better risk-adjusted returns over time. And I think what we're seeing is a consolidation around strategies that, that there's a high demand for strategies, for multi-strategies, for good portfolio construction reasons, which is it's an efficient way for allocators to be able to essentially gain access to a diverse set of strategies all combined into one. I think one of the challenges, and this is one of the more structural challenges of these sorts of things, is that anytime there's an alpha that's being generated, is uniquely differentiated alpha also almost always comes with uniquely differentiated fees. And so the net of fee outcome for the investor isn't necessarily better off. A simple example is that the multi-strategy funds net of fees returns are actually no better than individual strategy managers. And the reason why that is when you shift to a multi-strategy and then you charge 7 and 30 and have a 5-year lockup, the net outcome for the investor looks about the same as a slightly worse gross alpha with lower fees, right? And so there's that interplay for the actual allocators where they're not actually seeing the benefits. I mean, basically the multi-strategy funds they're certainly getting very wealthy. The managers are getting very wealthy, but there's not really much of a benefit for the individual allocators.
Great. So I think we have time to sneak in one last question. So the Fed seems complacent with 2 to 3% inflation. What happens if we have a no landing scenario and they don't remain committed, to their goal?
Yeah, I think the Fed and the governors as they stand today are committed to bringing inflation down to 2%. And I think there's a question of how fast and how and what the trade-offs are and what they can do and how much they need to do in order to get it there. But there's no, I certainly have no belief that the existing Fed infrastructure and policymakers that are there right now are on a path to abandon that goal. Now, that doesn't mean, the Fed by its nature is a political institution, not political in the sense of partisan at any particular point in time, but it is political in the sense of those who are appointed are political appointees in one way, shape, or form. We could have a circumstance where, the Fed has a set of decision makers that do choose to abandon that 2% target. I think that would be quite imprudent because by abandoning the 2% target, it would meaningfully increase volatility, uncertainty, right, about what the future path of inflation would be, because to the extent that you abandon 2 and 3 and 4, it's uncertain just how far you'll go. And that process of abandoning the target would create a meaningful rise in risk premiums across all financial assets. Just think, what kind of yield would you need to hold a long-term bond if there's real uncertainty about what the Fed's inflation target is? And that would create a significant impact on asset prices that would probably shift behavior away from that imprudent policy. But it's not clear. It's not certain that that would be the case. But at least for right now, with the folks who are in the seats today, it doesn't look like there's much appetite to abandon the 2% target.
Great. So I think we'll wrap things up here. Bob, thanks so much again for joining us today. We really appreciate you taking the time to speak with us and share your insights. Really enjoyed the conversation.
Yeah, thanks so much for having me. It was very enjoyable.
Great. Thanks everyone for listening in. Just as a heads up, we're planning on releasing a recording of the event in the coming days. So keep an eye out for that in the case that you'd like to revisit the discussion or maybe share it with others. Feel free to log off and have a great rest of the day. Thanks, everyone.